Now that you are eager to know how to grow your money, here is a video in which I would like to share the top 10 stocks you can buy now to possibly put a pretty penny in your pocket. From JD.com to dividend payers like Albemarle, so much potential to make money in these stocks. Sirius XM has just signed an important restructuring deal, and Ford is returning with electric cars. Both these companies can help you increase your investment portfolio in major ways. So stay tuned for more as we take you through the best choice that can change your financial future. Let's get started. Number 10. Sirius XM Holdings Inc. SIRI. Sirius XM is the audio entertainment company known mainly for its primary satellite radio services. The parent company also owns the Pandora streaming audio. Its shares have been low for some time lately, however, this can be attributed to the dropped previous buyout discussions. There is, however, a new beginning in it for Sirius XM. On September 10th, the company closed a restructuring agreement, which might make its shares even more appealing to investors and thereby give a boost to the valuation of the company. This makes it easier for the shareholder to track, like Liberty Media's tracking stock with Sirius XM. Number 9. Yum China Holdings Inc. YUMC. This is not the only stock to take a huge fall as China's economy remains on shaky ground. Yum China, operator of fast food restaurant concepts KFC, Pizza Hut, and Taco Bell in China, also sold on those concerns. The company operates all of the above brands, as well as a few other local restaurant concepts in China. Investors understandably sold YUMC stock in response to the shaky Chinese economy, with shares off about 50% since peaking out back in 2023. But the underlying business is actually holding up pretty well. Yum China will also see its top line up 3.7% for the year, an all-time high record. Number 8. JD.com Inc. JD. While JD.com is certainly a growth play, it's gotten relatively very cheap lately. The stock more than tripled its share price from around $30 to over $100 for that intervening period between 2019 and 2021. However, the stock price has retreated to levels around that when the company went public in 2014. Much would probably feel shocked given the fact that JD is much larger and raises much greater revenue than it did 10 years ago. JD revenues rose up to $83 billion for the year 2019, up to $153 billion for the full year of 2023. Experts predict that the growth will continue up to $167 billion in revenues for 2024. In August, JD announced another earnings report beating expectations and cleared a new $5 billion plan to buy back its shares. Number 7. Albemarle Corp. ALB. Albemarle is the world's largest lithium producer, and operations are spread across North America, Chile, and Australia. Albemarle has been successful to put consistent and steady performance for decades. It is announcing a consecutive 29-year higher dividend payout, making this company one of the few dividend aristocrats in the group of basic materials. In the last 18 months, lithium's prices dropped sharply as China came in with relatively low demand. Bad news on the lithium front occurred on September 11th, however. A report issued by Citi stated that a major producer, Contemporary Amperex Technology Company Limited, would likely curtail its production. This should stabilize the market. Number 6. Adient plc, ADNT. Adient is a company that employs about 70,000 workers and plays a significant role in making car parts and materials. Seating systems and components are primarily among the products. The car market contraction also affected an attitude towards manufacturers of auto parts aggressively. For instance, stocks for ADNT had fallen by about 50% within the last year alone. This appears a bit of an overreaction, given that it is estimated that sales would decline only by 5% in 2024 before it would begin to surge again in the following year. Still, on this year's soft results, the stock sells for only 12 times earnings and goes for an estimated 7 times earnings based on expected 2025 results. Number 5. Ford Motor Company, F. High interest rates have crushed parts of the economy, one such example being the auto market. Demand for new and used cars has nosedived recently after it had sold a lot during the pandemic. This has meant far too many unsold cars for car makers and pressure on prices throughout the industry. Investors are also concerned about a slowdown in demand that a recession would bring about. The electric vehicle segment has been especially beleaguered, Ford reporting large losses on its EV business for some months now, but lower interest rates should help boost demand for new cars. Number 4. Global Payments Inc. GPN. Global Payments is that financial service company which makes use of payment processing technologies. It lets businesses accept the wide repertoire of payments, including checks, debit and credit cards, and even digitized and contactless. Like all companies did, Global Payments took advantage of the pandemic too. Just as the penetration for cash decreased and the digitization of payments increased, businesses quickly upgraded their systems. Number 3. Endava plc. DAVA. Endava is a British information technology consulting company. It is about UK and clients in Europe, especially the banking, financial sector, and service payment industries. It has entered new markets and geographies recently. For example, it bought the Galaxy Group in April to enable it to provide healthcare consulting. Endava had experienced a sharp decline in its share in the last 2 years due to client spending cut on IT services. It was due to the return to the office with the fall of need for digital services. But now, times seem to be changing again, and Endava is set all geared to regain its double-digit profit and revenue growth once again in 2025. That makes the stock a pretty good value for money at the moment since shares remain about 80% off their 2021 high. Number 2. BCE Inc. BCE. BCE is a telecom business in Canada that provides TV, wireless services, and broadband internet. This means it has over 10 million customers and accounts for nearly 1/3 of the overall Canadian telecom market. Like many phone companies, BCE stock has not done well in recent years. While till now, investors were worried about the high prices of 5G network setup and increased interest rates, the positive word currently is the start of a rate-cutting cycle, and the sector of telecom has bridged most of the 5G setup costs. First off, the yield of BCE at 8.2% will continue to show appealing while interest rate goes down and investors move from the fixed income to the high-paying stocks. Number 1. KHC. KHCI is now a value stock over the last years. Kraft, the large food conglomerate, could not avail all the expected benefits of the merging deal the company had entered with Heinz way back in 2015. Meanwhile, the huge debt burden saddled to finance that deal left the company limping in its quest to find a new direction. It cut its dividend in 2019 and started selling some of its assets and made other smart moves that improved the work. Apparently, these moves start paying off now. The stocks of Kraft Heinz increased $1.58 in 2019, compared to $2.31 in 2023 end. Analysts expect they will start to increase even up to $3.02. That means a stock is around 11 times the earnings expected. This earnings growth is particularly remarkable, considering that so many companies selling ordinary goods have stumbled since the pandemic. Thanks for watching. What do you think of these stock picks? Do you already hold any, or are there others you're interested in? Let's hear from you in the comments below. If you enjoy this video, do not forget to click that thumbs up below and subscribe for more updates on the best investment opportunities available for you.